I'm George Ogilvie, President and CEO of Arizona Sonoran Copper Company. We're a Toronto main stock exchange board listed company, and we have the Cactus Mine located in Arizona in the United States of America. It's a brownfield site, and the company today is actively working through the technical studies, inclusive of a pre-feasibility study, and in 2025 a definitive feasibility study. And our goal is to move this operation through into commercial production over the next 3 to 4 years at a time, when there's going to be significant demand for copper in the US of A.
George, thank you very much for the introduction. Not just the US of A, I think there's going to be significant demand for copper around the world. My goodness, we've got so much to talk about today. You've just put out a PFS study. You and I are both heading off to Toronto for the PDA, the Prospectors and Developers Annual Conference. You've just back from BMO. You've had a whole series of meetings there. The markets are still really tough for explorers and developers, particularly in some of the key commodities that I think have got superb fundamentals, not least oil and gas and gold, and of course copper. Before we jump into the pre-feasibility study, can you just give us me a flavour of the meetings you had at the BMO conference?
Yeah, we met with probably half of our meetings were with current investors of the company. And then we were meeting with potentially new investors, principally buy-side institutional accounts. And of course, similar to what you said there, Merlin, everybody's certainly paying attention to copper. The general feedback that I received was that everybody believes in the next 2 to 3 years we will begin to see a structural deficit in copper. People are pretty upbeat about the demand, but the structural deficit will actually come from the supply side, is what I'm actually hearing. And of course, we've seen that this year, in that the analysts were forecasting 2024 would be a year of surpluses when it came to copper concentrate and refined copper. And here we are barely 2 months into the new year, and there's been 700,000 tons of copper production taken out, and suddenly we're either balanced or most analysts are saying we're going to be in deficit this year. So that's come a couple of years early, and that was the general feedback that we received. So there's not a lot of money out there, as you said, for the explorers and the developers, but there's definitely a lot of funds that are paying attention and trying to pick what are the right companies that they would want to invest in at the right time, as soon as they get an indicator that the market is beginning to turn. Personally, myself, I think that will occur before the end of this year. I think we'll see the Fed cutting its, federal rate of interest. I think once that happens, the US dollar will begin to weaken. And normally when that occurs, we start to see, commodities that are priced in US dollars starting to strengthen. So I think gold and copper in particular are two that I certainly would keep an eye on.
I feel that the smart money kind of can look at these fundamental shifts in the market and will kind of allocate its capital ahead of time, just to kind of to sit, because it's very hard to second guess the exact timing. So I do kind of take my hat off to the funds and the institutions and the investors on an individual basis who just say, right, well, we were right on uranium. We knew that was coming. We can see copper as the next one. We're just going to look for some quality names. We're going to bide our time, buy the shares, and we can't predict the timing because there's so much noise in the market. For example, and around Nvidia and the tech stocks. There's so much kind of oxygen which is taken up by that. But in almost the smart money is kind of getting set now. I don't know if you've got a view on that.
No, absolutely. I think you're right. I mean, obviously, there was a big run-up in the uranium price late last year. That's tapered off a little bit now. And I think you're right. Everybody's really heavily invested into tech with AI. But that may have run its course. And the smart money, I think, is already looking to redeploy into sectors that have been pretty much beaten up, let's say, in the last 2 years. And I'd certainly say that the materials sector is one of those, and certainly copper is an area where I think everybody openly sees that with these structural deficits, there's going to be huge opportunities to see significant returns on investment and capital deployed in the copper sector.
Well, let's get to the specifics. Arizona Sonoran Copper put out a pre-feasibility study recently. I think it's fair to say that the market gave you a bit of a spanking, really. It didn't, it wasn't taken favorably. The share price didn't go the right way. But we were just talking offline just before this, and you were talking about the capex number being a shift between the PEA and the pre-feasibility level. But the PEA was 3 years ago and on such a different beast. I think it would be really helpful if you could just describe to the viewers what the difference is in terms of these are two. It's not apples and apples or pears and pears.
No, it's apples and oranges for sure. So 3 years ago when the PEA went out, it was looking at 28,000 tons of cathode production a year. It was focused in on 3 assets that we had at the time: a historical surface stockpile, the Cactus West open pit that was previously mined by ASCU and then known as the Cactus Mine, and next to it there was a small underground mine called Cactus East. And the capex to build that was $124 million. But the former management, when the PEA went out, were taking run-of-mine ore from the open pit and underground and essentially putting that in the large trucks, driving it up onto the leaching pads, depositing it down, and then expecting to irrigate it and produce a pregnant leach solution that then gets pumped into a SXEW plant. Well, over the course of the last 3 years, we've found a discovery at Park Salyer. We've grown the resource now to 7.4 billion pounds of copper in all classifications, and it's now a very different mine. So today, the PFS that went out was 55,000 tons of cathode production. The mine life, on average, annually, the mine life is 21 years. And the capex number has now risen to $515 million US, inclusive of a $75 million contingency. But the capex includes now primary and secondary crushing, which was never in the PEA. We do have fines within our surface stockpile and from the ore that we will blast and drill and blast. So some of the fines, they have to be agglomerated, so there's agglomeration drums. And you never really want to put big, heavy equipment on top of leach pads because the top 10 feet of the pad essentially gets compressed. It becomes like a cement block, and you really can't irrigate or get the permeability and porosity, from the heat leach to actually get the copper in solution. So to avoid that, we go with conveyors and stackers. So in my opinion, if we were doing the PEA 3 years ago with all of this dry site process plant that was never incorporated, the number 3 years ago probably would have been around $250 million US. And then since then, obviously, we've now doubled production, and the world has seen, hyperinflation in the last couple of years that it hasn't seen in decades, coming out of post-COVID. So when you factor all of that in, that's why we get to 515 million. We look at numbers like capital intensity, and the PFS is showing $10,300 a ton of cathode being produced is the capital intensity. And when you actually look at other copper development stories around the world today, that number is in the lowest quartile. There's quite a few mid-tiers and seniors that have come out recently and given capex numbers for their expansion projects or brownfield sites, and they're looking anywhere between $20,000 and $30,000 a ton. And if we just go back quickly to the PEA, if we look at the capital intensity of that project 3 years ago, it was under $5,000 a ton. I can assure the listeners and the viewers that there's no copper project in the world today that's going to get built for under $10,000 a ton. That's the reality of the world that we live in today.
Your comments about the kind of inflation that we've seen in the last few years. I did a bit of a dive into the kind of the commodity, the structure of the commodity of the copper industry on the supply side over Christmas. And when you look at the rate of new discoveries, you look at the timelines for development. You're talking kind of 17 years for a kind of a medium-sized copper project to come into production, and actually, the last big discoveries were about 17 years ago. So we're coming to this critical phase, and a lot of the deposits are lower grade, a lot of them are deeper, and then you start factoring into the equation that when something is lower grade, you need more steel for your process plant, and when something is deeper, you need more energy to bring it to the surface, and when something is lower grade, you need more energy to crush and in the comminution circuit. So I don't think that these inflation numbers are kind of really baked into the copper price. Really what we're seeing is the copper production at the moment is very much a function of the investment, of past investment, but that the next wave of investment is going to need, I think, a higher copper incentive price. Exactly.
Yeah. With the copper price. Yes, there are a lot of projects around the world that sub $4 a pound of copper, and I think copper today was around $3.85, but sub $4 a pound copper will not generate the type of internal rate of return or the return on capital employed to justify, taking the project forward. We're in a very fortunate position with Arizona's Sonoran that, although $515 million is a big number, compared to a lot of projects out there in the world today, copper projects, that is actually a very small number. There are a lot of copper projects built in the last few years and others that are envisaged, but they're going to require billions of dollars to build them. And that then, equates to execution risk. I'm not saying in this situation it would occur, but, with a $500 million spend, if you have a 20% overrun, then, you're looking for another $100 million of capital to fill the hole. If you're building something that, let's say, is, $3 or $4 billion capital, and you have a 20% overrun, suddenly now you're looking for $600 to $800 million. That's a big number. So that's another beauty, I believe, of Arizona's Sonoran, is that the capital intensity is low, but the execution risk is low as well.
You mentioned IRR, and your PFS was done on a price of $3.90 a pound.
Correct.
And it gave an IRR of 15.6%.
15.3% to be precise.
15.3. And 15.3, that's right,
yeah,
post-tax.
The three after tax. And the $3.90 comes from the consensus pricing with one of the large banks that looks at 40 to 50 of the analysts that cover the sector and then takes a weighted average consensus price. And that, at the end of January, that number was $3.91.
Does 15.3 kind of make you feel uncomfortable? Does that feel a bit low? Obviously that one wants to see a higher IRR price, but...
Well, look, it's a great question. No, it doesn't make me feel uncomfortable. And the reason for that is that, we've got no intention of project financing this project on the back of this PFS. It is merely a stepping stone to future engineering studies that will see further improvements in the economics and the IRR of the project. So we wanted to get information out into the market sooner rather than later that was very relevant for today's copper space. We realized in the last year as we embarked on this study that the PEA was very outdated and wasn't realistic of the reality of what we're facing as a company. So I think getting these numbers out was the right thing to do. And the reality is, and we just touched on it as well there, Merlin, but the reality today at under $4 a pound of copper, you are not going to see many copper projects with IRRs after tax better than 20%. And there's been some senior CEOs of some of the senior copper producers in the last several months that have come out and publicly stated that they are not looking at organic growth or expansion projects within their own organizations at copper prices around $3.80, because the IRR on their projects is sitting at around 11 or 12% after tax. They would rather accumulate cash, strengthen the treasury, and give that money back to the shareholders in dividends. And the issue we have as an industry is it's going to be feast or famine. And at the moment, there aren't enough copper mines coming into production to satisfy that demand. And when that demand comes, suddenly there will be a flood of money back into this sector. And unfortunately, there will be projects that should not get financed that will get financed. And then we end up in this cycle when we have projects that fail and we haven't deployed the capital effectively. And I've seen it over many cycles in the past. This is coming again, and this one is going to be even more abrupt than what we've seen in the last 3 decades.
Well, you've said that you want to, get a shift on towards production. You're a mine builder. You've also spoken about having a feasibility study out in the middle of next year. And yet, I know that feels like a long way away, but it's only 15 months away. And there's a huge amount, there are many moving parts here. You've got lots of
optionality,
lots of exploration to do. Would you be willing to just kind of to see how the exploration goes and for the next 3, 6, 9 months, and then make a call on the kind of the delivery of a feasibility study?
Well, what we've committed to now is we have a property called Mainspring, which is not in this PFS. It's not even in a resource, and it appears to be now the southern extension of Park Salyer. Now, Park Salyer, the mineralization, the top of it occurs 300 meters or 1,000 feet below surface. In this PFS, we mine 96 million tons out of that deposit over almost 18 years. And it's a big underground sub-level cave operation. And as we've drilled to the south of Park Salyer, we've seen mineralization coming to surface within 42 meters or 150 feet. The inferred drilling for Mainspring is now complete, but we don't have all the assays. And I would anticipate probably sometime in April, May of this year, we'll probably put out all the assays on Mainspring and an updated mineral resource estimate. And we've currently engaged an engineering company to assist us, an external company to assist us with a preliminary economic assessment that will come to the market by the summer of this year. And that PEA will include Mainspring as an inferred resource. But one of the other reasons why we're doing it is we have this Newton technology that looks at the leaching of a primary sulfide again, which is not included in any of our current stated business plans. And right now it's essentially a stranded resource, meaning the shareholders are getting no value for that. And then the global resource, which I referenced earlier, we've actually got 1.6 billion pounds of copper in primary sulfide, in this case, chalcopyrite. So we did column tests last year with Newton. We were seeing recoveries between 70 to almost 85% after 200 to 220 days of leaching time. And given that the primary sulfide sitting at the site is in the inferred category, we then have the ability to bring it into this PEA. So the market in the next 4 or 5 months is going to get the first look at a PEA with Mainspring included, and then layered in on top of that will show what value add we can see from Newton. And I think once we've got that out into the market, we're at a point in time where we can decide what do we want to do going forward with respect to the various options that we're going to have on the table.
Because typically one works through these trade-off options at a PFS level rather than, you do your trade-off studies at this level of engineering before you do all of the detail engineering on a kind of a final operating plan, which is the feasibility study. So
yeah, exactly. So that's why when we get the PEA out, we'll then be able to determine, okay, what option do we want to take going forward? Are we going to go back and do a pre-feasibility study, or are we going to move right forward with a definitive feasibility study? And remember, although I say it as a PEA, and it is a PEA, with the PFS being completed on all of the other assets, all of the costs and everything that would be in that PEA, 80% of it will be to a PFS level.
Yeah.
So that's another important point to bear in mind.
Newton, it's a kind of a proprietary technology owned by Rio Tinto. What's the basic concept behind it? What does it do? The
basic concept is that they've developed in-house a technology which they believe allows them to leach primary sulfides, once they're on a leaching pad, and then it would produce a pregnant leach solution that goes into a standard SXEW plant. The beauty of that is that the capital intensity for these type of operations is much lower than you would expect from a traditional flotation mill. From an ESG perspective, it's much cleaner as well. Remember, a flotation mill produces a concentrate. That concentrate has to go off to a smelter and be further refined. I mean, at the end of the day, we believe the bulk of this new copper demand is really going into the green energy transition to move away from fossil fuels and hydrocarbons. It kind of defeats the purpose, if we're throwing in all this energy and generating all these greenhouse gases to ultimately put it into an electrical vehicle. So I think, Newton from an ESG and a social license perspective, is definitely the way what the industry needs to be pursuing.
But is it specifically kind of a hyper chemically active solution, or does it kind of is it a preparation that you do on your ore that then kind of opens up the structure of the mineral so that your normal leaching agent can be the chemically active part against the copper mineral?
It's all black box and proprietary. We don't quite exactly know, but yes, it's all based on chemistry. And from what we can see at the moment, yes, it seems to unlock, the chalcopyrite, and then within the various recipes, it's able to leach out the copper and put it into a pregnant leach solution. And the beauty of the technology is that it allows you to take advantage of a standard heap leach and SXEW plant. But if you can get access to more tons of primary material, but you're already building the plant, you might be able to significantly increase production at only an incremental cost increase. So it's not a situation where you double production, but you double the capex. It could be a situation where you double production, but capex only goes up by 20%. And as I said, we think we've got a very robust plan, notwithstanding the capex that's in the PFS going forward. We're getting no value for the primary sulfide. And if we're able to leach that out of the ore with the Newton technology and take advantage of all the infrastructure that we're putting in, we think this is going to be hugely accretive for the shareholders of the company. And then don't forget, with the option to JV that we announced last year, with this agreement that we've put in place, essentially the project under the Newton scenario is de-risked from a financing perspective and an execution perspective. And that is the holy grail for junior companies that are explorers and or developers, is how do we finance the project without massive dilution to the shareholders of the company?
Remind me the terms of that. They can pay 60% of the NPV, is that right? Or is it 40%?
Yeah, it's 40%. So the way it works is that they gave us, first of all, $33 million last year on non-equity, non-dilutive financing. $10 million we get to use whichever way we want. $12 million is for the Newton program at the site this year, principally drilling out the primary sulfides. And there was another bucket of $11 million for a couple of land payments which were due in the next 12 months. But beyond that, if the Newton integrated PFS at a future juncture in time is able to uplift our own base case PFS by 1.39 times, they have the ability to earn into the project at a 40% at the asset level, But the issue is they have to pay us for that, and it's set at a 0.65 times P/NAV multiple. So if we use the numbers today from the actual PFS, and let's just say, the NPV was 509 million after tax. Let's use 500 million. 40% of that is $200 million, and 0.65 times that is $130 million. Now, when we go to the project financing side, and again, I'll just use easy numbers so we can do the math. Let's just assume that's $500 million as well to build the project. Each party is responsible for their pro rata share. So Newton has to fund 40%, which would be $200 million, and we'd have to fund 60%, which is $300 million. If we then take that $300 million and we split it, 50% debt, 50% equity, I've got to fund $150 million of equity financing. But I just received $130 million from Newton to buy into 40% of the asset. So now I'm only looking for $20 million of equity. So the number of shares that I'm issuing goes down substantially. And on a NAV per share basis, it's anywhere from 40 to over 100% accretion on already the base case plan. And then on the debt side, with Newton putting money into the project, they will also provide either or completion and or performance guarantees on the technology. When we go to the commercial banks or the debt lenders looking for debt, and we're able to show that Newton is putting money into the project and providing these type of guarantees, the likelihood of getting competitive debt financing, in my opinion, is quite high. And the other thing that we covered off was that if we couldn't get debt financing, then Newton has to step in and provide us with the debt funding at reasonably commercial terms to be negotiated at some point in the future. So the $33 million that we got from Newton, as my CFO likes to say, was really just the ticket to get into the amusement park. Nobody has bought the ticket yet to get on the ride.
Yeah, gotcha. Newton is fantastic leverage and fantastically important for the company. The processing engineering cynics out there, of which there are many, will say that people have been trying and testing kind of revolutionary techniques of hydrometallurgy for decades, and there's nothing really new under the sun, and leaching is just leaching, and you just got to, if you want to really crank it up, you've just got to chuck more acid in and maybe a little bit of salt, and maybe increase the temperature, maybe increase the pressure, and just do that and change away from atmospheric conditions. Now, obviously, Newton believe that they've got something which is revolutionary rather than evolutionary.
I certainly think so, Merlin, and the reason why I would say that as well is, they just gave us $33 million of their money, and that is a very, very bold statement. So I really believe that, they're very confident that they can prove that this technology can work. And that's one of the drivers and the reason why they've chosen the sort of portfolio or suite of companies that they've engaged with so far, is that they look at them and they can see that these projects have the potential to all be in production within the next 5 years. It's all very well, experimenting in a laboratory, but, where the road or the tire is going to hit the tarmac is when we go to either a pilot plant or into full-scale commercial production.
Well, that was the question: is are they going to do for Rio Tinto, the value that this would open up for them is just immense. So in a sense, they could afford to do a $300 million build almost and write it off. And they did much more than that on their hot briquette iron plant up in kind of Pilbara and other places. Are they going to do a pilot plant?
Well, look, I can tell you when we were engaged with them and they were showing us, what they had did internally over the last 3 decades, they did run a pilot plant at one of their own operations. And they showed us the results of that, and it was very, very encouraging. It's not to say that we're not going to run a pilot plant here and, scale it up on a gradual basis, but I've seen information from the test work that they've done over the last several decades, and it looks very encouraging. And I can tell you as well that prior to my arrival at ASCU 2.5 years ago, we were testing other competitors' technology. And from what I've seen so far, Nuton certainly looks to be the superior product.
George, this is really, really fascinating. I appreciate you've got to go get ready for the PDAC, and I do as well. I think that's been a really good session. Good luck with the work program of the coming months. Perhaps by way of summary, you could just kind of talk about what you're trying to deliver over the next 6 months.
Yeah, thank you for that, Merlin. And just one thing with the Nuton, look, it is unproven technology, and that's why we're not putting all our eggs in one basket. That's why the management is still pursuing a second work stream, which is our own go-it-alone plan, because if we get to the end of the year and the technology doesn't prove as successful in the laboratory as last year, or they don't meet that financial trigger, or at their discretion, because it's at their discretion, they decide not to exercise the option to JV, we have to have a fallback position, and that's what the management of the company are working on today, and hence the reason why we put out that PFS, to show the market that we have a solid standalone plan. It's not the finished article, but we're well on our way. Think about where this company was 3 years ago with 28,000 tons and 3.5 billion pounds of copper in the ground. Today it's 7.5 billion tons, and we're now at 50,000 metric tons of production over 21 years, and that's only going to grow with Mainspring coming out in a PEA sometime in the next 4 to 5 months. So it's two work streams going hand in hand, and that's the rationale behind it. But you'll see a mineral resource estimate coming out in the next 3 months, with Mainspring coming in there as an inferred resource. That leads into the PEA inclusive of Mainspring for the go-it-alone case. Then we're going to show the market within that report the optionality of Nuton and what it can bring to the table. And then from that, we've got a decision to make whether we carry on with an updated PFS for the standalone. And we're certainly committed to do a PFS for Nuton. And beyond that, at the moment, it's still looking like a definitive feasibility study in the middle of 2025.
Plenty to be getting on with. And of course, in the background of, we hope, an ongoing supportive copper market. George, thank you very much.
Thank you ever so much, Merlin.